pitfall with those is, you don't actually have shares in the company yet. You don't actually have the equity ownership. You just have the option to purchase it. Well, now everyone's equity has been cut in half. They're talking about shares in a company that doesn't have any clearly defined value. Sell your shares in a way that's manipulative.
What's up, guys? Welcome to Craft Cohort channel, and today finally Craft Cohort co-founder joins the party. Kurt, I'm so happy to see you on our YouTube channel. How are you today?
I'm well, thank you, Dmitry. Thanks for having me on. I know we've been trying to connect on this for a while here, and mostly due to my schedule, we've had some difficulty doing that, but glad to finally be doing this with you.
Yeah, glad to hear that. So, we co-founded Craft Cohort in November of 2023, and prior to that, Kurt was running his own software development company for about 15 years, and I was running my software development company for about 10 years. And over the past decade, I received a decent amount of suggestions to do software development at a lower cost in exchange for equity. And I declined all these suggestions because I was focused on generating cash. But in our recent conversation, Kurt mentioned that actually occasionally he accepts these suggestions. So I thought it would be a nice idea to cover this question on our channel. So Kurt, first of all, can you please share your experience in reducing the software development cost in exchange for company's equity?
Absolutely. And it's really not about reducing software development costs all the time. Sometimes it's just about your participation in the company and everything you'll be contributing to that company. So as an independent provider, there are a few things that can come across your plate. And those can be things from going out and making a proposal for a company that's reached out to you or that you've reached out to directly, and you come to them and say, hey, here's what it'll cost to build whatever you need. That number may be higher or lower than that company is expecting, and depending on where they are in their stage of development, if they're a startup company, they might not have the cash to be able to purchase those services outright, or they may be well established and that's just how they operate. So a lot of time equity becomes a negotiation tool. And the way we can approach that is based on where that company is and where you are as a company as well. So when I started off early on in my career, early on in my company's existence, when we were getting new companies, a lot of the time you're working with organizations that haven't been in business for a long time. Most often they're startups, and those are where you're going to have the greatest occurrence of this equity offering, pardon me. So what you'll have is companies offering you different types of equity for different participations, for different discounts. And I've had, let's go through the list here. I've had direct grants of ownership in a company. That's where a company says, hey, we have 1 million shares of stock. We're going to just give you 100,000 shares. And you're going to become part of our internal team, or you'll still remain an independent contractor, independent company. And then for that, sometimes you negotiate a little bit of a discount, and sometimes you don't. Sometimes they're doing that because they want you just to be there and to participate and really have a vested interest in that project's overall success. So grants are always the easiest. There are certain tax implications that you always have to be aware of when that occurs. But most of the time that doesn't come into effect unless you're actually given the shares of stock. A lot of the times when they're doing this, it's a contractual obligation that the company is entering into with you. And they're saying that, at a future date or on our cap table, the capitalization table, where they keep track of all their stock offerings and who has what, they've got you marked down in there, which is something that's usually filed with whatever government that company is registered within. So if it's in the United States, it's usually on a state level. In other countries, usually be on a country level. So grants are pretty straightforward and easily managed. Usually they're just kept on the books. Occasionally they're actually distributed as shares of the company. So another option that you're going to come across are stock options. So stock options are where you're granted the option to purchase stock in whatever company you're looking to work with at some point in the future. The idea is that typically the price that you can purchase these stock shares or stock certificates at is going to be lower than it's going to be in the future. So the pitfall with those is, you don't actually have shares in the company yet. You don't actually have the equity ownership. You just have the option to purchase it. So if the company never does anything, or if for some reason the value of that equity decreases, well, then you don't really get to take part in that benefit. So we'll get into a little bit into the pitfalls of some of these options later on here as we get deeper into this. But those are the two basic options that you come across. Either this direct equity grant or this options grant, which are a little bit more difficult to work with. So when you get into these things, always be mindful of where the company is going, because you as the service provider have direct costs. So my developers, when they're doing the work, I have to pay them no matter what. So if the company doesn't pay enough, or we're doing this exchange of equity for a discount, I'm the one who has to absorb all that risk, unless it's something where I can talk to the development team specifically that's going to be working on that project, if that's something that they want to take the risk in as well. So those are just a few ways to kind of look at this at a broad level, and we can dive into a little bit deeper on each of those subjects.
Yeah, thank you. So I'm curious that you mentioned the company you mentioned, they are mostly the established company, like having options or share stock. But very often people suggesting equity, they are at an early stage. So they consider that you will be just a co-founder. So being a co-founder for equity, does it, from your point or from your experience, does it good option, bad option, or you should try to go with something else?
So it can be a really good option if it's something that you believe in. If you see the idea as it comes across, usually at this point, you've been given a rundown of what it is the company wants to do, what the problem is that they're looking to solve. And if you look at that yourself and say, wow, this is actually something that's really interesting, something that I'd like to participate in a more involved manner, then becoming a co-founder with them is certainly an option to have on the table. So by being a co-founder, or when they're asked to be a co-founder, a lot of times that's going to come with some type of equity involvement, whether that's a grant or an option, but also that's going to usually involve some type of increased involvement and probably reduced rates. Most of the time that would be you as the individual. So in most cases, it would be me discounting my rate for being involved. So I would say, hey, I'm not going to be adding onto an invoice or anything my direct costs. If I'm working as a product owner or a product manager or development engineer or whatever that case might be. Or I may be reducing some of the rates overall, because we all have margins built into this, and that's how we then keep the companies alive and kicking. So the other option is you can always see if the team that's going to be working on that specific project is going to be interested in also maybe taking a reduction and then taking equity as an option. So there are a few different ways to approach that, but a lot of it's going to come down to whether or not you truly believe in the project. If what you've been presented to up to that date has really piqued your interest, and it's something where you say, yes, it's worth the risk. The reward and risk balance is always something that we have to consider here. And if that's the case, then it's something you should go for. But I have had a few of those be successful. I've also had many of them not be successful. It's just the nature of the beast, especially since when you're being asked to be a co-founder, you're usually dealing with a startup at its very early stages, where they're looking for a lot more guidance, advice, and cost savings, to be frank.
I see. So basically, as I understand to this point, there are like three major options: is to be a co-founder, is to get the shares, and get the options to purchase shares. So in this case, the software developer plays the role of the investor. So does the approach should be like with the investor when you need to ask for the marketing strategy, for the go-to-market strategy, for some numbers that might be confidential?
So yeah, a lot of the time when it gets down to making these final decisions, usually negotiations have been going on for a period. And then it is important to understand what their go-to-market strategy is. How are they going to make money with this? Because you as the individual, you're definitely spending money on development. You're being promised, you're basically being promised a paycheck at some future date, but you'd like to know how they're going to get to that paycheck. So asking for marketing plans, asking for funding strategies, how they're going to be bringing in other funding. Usually if it's a startup, they're actively going out, getting other investors to come in. So you providing discounted services, basically, like you said, are becoming an investor. So you should have access to the same materials that other investors would have access to. So that's definitely something important to consider as you're doing this, as well as, considering what your position is. When we talk about co-founders, we're not necessarily talking about what position, but a lot of times people are going to try and assign like a CTO position. That's a very common one to try and decide to, or trying to apply to an outside development firm. Usually the owner of that or whatever the project manager, or depending on how it's being structured, they might be asked to be a CTO or some other type of C-level officer. And that is something that I actually try to avoid. Where we operate in the United States, there are a lot of liabilities that come with being considered an officer of a company. So my advice to anyone who's been offered something like that, while the title may sound intriguing, probably best to decline that and stick with my favorite is stick with a head of, head of development, head of technology, whatever that might be. It doesn't have the same connotation as being an officer, but you still have the involvement, and you can still be considered a co-founder, but there's just pitfalls that you want to be aware of depending on how your name is being listed and used. Because I've worked with companies in the past where we were doing everything correctly, but an owner may not have been doing things on the up and up. And anyone who's involved in the C-suite, as we call it, can be potentially liable for things that were done because you're supposed to be aware of the inner workings of a company. So keep that in mind when being asked to be a co-founder, but definitely consider your options as far as whether you're going to be taking pay reductions, whether you're going to get options or direct granted equity, and then make sure to do your due diligence and really dig into the strategies and plans that the company has for going to market, monetizing everything, and see just how well they've vetted their ideas.
I see. Can we circle back about this C-level liability? So if you are co-founder, but you're not C-level, then liability level is lower. For example, if something happened, like company didn't pay taxes on time and the feds come in after the company, as a co-founder, are you protected if you're not in a C-level position, or you still will be responsible?
So that's actually a very deep and loaded question because it changes depending on states, countries, territories. So you want to be really careful with that. But usually the problem that you'll run into is if your name is on filing paperwork. So if that company is like I've worked with publicly traded companies before, which is something else we'll discuss as when it comes to exit strategies or cashing in on your options or equity grants. That's something we need to get into here because that's a whole nother slippery slope. But with publicly traded companies, they're putting filings out all the time, and in those filings they usually state who the officers of the companies are. Co-founders aren't necessarily officers because they aren't being put down on any of that paperwork. Usually they're just considered equity holders, and they may have deeper knowledge of the company, but your liability structure is less when you're just a co-founder. So a lot of it's going to depend on how the paperwork's actually written up, how your contract with the company appears, and that also changes the relationship a lot. When you're a co-founder or when you're working very closely with these companies, a lot of times you're considered an independent contractor. But if you work too closely with them, you run into the possibility of being considered an employee. And when you're considered an employee, there's just a lot more to be reviewed from both your side as the service provider and the company's side, because they may have certain employee obligations or employee reporting obligations that they need to adhere to.
I got it. So if we talk in terms of startups, what would the average percentage for software development company equity when the startup at the idea stage or when the early stage without no recurring revenue?
Sorry, could you ask that one more time? So you're asking when a service company such as like what I've run or what we're currently doing now will get brought into the conversations with a startup company?
Yeah, so basically, let's say a startup is looking to create software product, or they have MVP and they need a long-term support and evolve in the product, and they're talking to software development company because software developers are expensive and they want to reduce the cost. So let's say these two stages when there is just idea mode and they're looking for CTO/co-founder that will help them to be established, and at the stage when they have the MVP and they need to evolve. What would be the average percentages for the company, the equity shares?
Okay. So yes. Well, so usually when you're talking with companies that are in their very, very early stages, that's usually when you're talking percentages, because at that stage of the company, they know where all of their equity is. They're usually giving out larger percentages at that time, because the idea is that you as early founders or early individuals being involved are going to get diluted. So that's when a company starts off and they issue out 1,000 shares, let's say, and everyone's got their little piece of the pie. Well, then a new investor comes because they need to raise more money. And so when they do that, they need to release more shares in the company if all the shares are already spoken for. So when they do that, they issue more shares, and that causes dilution. So if everyone had their percentages at 1,000 shares and the company brought in an investor and had to issue another 1,000 shares, well, now everyone's equity has been cut in half. So that's usually at that stage when they're talking about percentages, in those early stages when you can actually track those percentages easily. When a company starts getting into its later phases, after it's gone through a few rounds of fundraising, a lot of those instances, they're going to be giving out just a share count, 50,000 shares or 100,000 shares, which, often you at that stage don't know what that means. Is that 50,000 of 100,000 shares? Is it 50,000 of 100 million shares? There's a big difference there when you're talking about it. And the thing that you run into with a lot of these startups is, they're talking about shares in a company that doesn't have any clearly defined value. Unlike a publicly traded company where you can say, hey, every share of this company is worth $1. When you're talking about a startup, every share is technically worth nothing until that company has a way for you to sell it. So what you really need to do is understand how the company is determining their valuations. And from that valuation, you can determine the total number of shares that are being issued out to everyone. And then from that point, you can say, okay, so I have 50,000 out of 100,000 shares. And you can do the math, figure out your percentage ownership there. But that starts to become more and more difficult as a company continues to raise money, go through different seed rounds, and then your percentages all get diluted. But as far as like common percentages, what you actually should look for, if you're at the very early stages, this is going to depend on what you're bringing to the table, and how much you're discounting your services for. If you're providing, all the development service costs for free, well, then you're still going to be absorbing that cost as a company. So what you have to do is say, okay, so let's say this goes on for a year, and that's going to be $200,000 in development costs. Well, what you'd have to do is now that you're investing your time, energy, and company's time and energy to that level, you need to understand what they're raising capital at. So if someone were to come in off the street and say, hey, I'm going to give you $200,000, how many shares in the company are you going to give me? that's what you need to do it based off of. Now, if there's none of that there, and if you're not discounting your services entirely, let's say you're just providing a smaller discount, but you're going to be very intimately involved with the planning stages, the go-to-market strategies, and figuring out how this works. When you're moving into that co-founder role, that's when you can start asking for larger percentages. I've worked in roles before where myself, the CEO, and a couple other key members all had equal share ownership because we're all providing the same amount of effort and energy for a very early startup. I've also had it where I come into a company later in its process and the equity ownership isn't as high, but usually the service discount or the amount of direct involvement that I might have might be lower.
Oh, that's interesting. So basically when you have the percentage of the company, I mean, like a company need to be accredited to issue shares, right? And startups usually do not spend money on this stuff. So they just share, let's say 20% or 30% of the company. And that make life easier for a new investor or shareholder, because if the company costs billion, you just get 30% of the billion, right? But this complicated with the shares. I know this is a pitfall for angel investors, that if the deal is not structured well, they can lose the equity and they can have 10%, and then after a few rounds of investment they can have 0.5%. So what are the typical pitfalls for software like shareholder? Because this is basically the same investors as we already talked. So what would be the potential problems and how to secure them?
Well, actually the problems are pretty similar, because you as an individual who, even the basic employees who are working for a startup company or even larger companies, they all suffer the problems of dilution. And unfortunately, there's not a lot that you can do to avoid that. It's kind of a natural part of companies' growth when they go through and they need to raise more money and they have to dilute everyone further. What you can do is you can come in there and be like, hey, so we're doing another round of funding. That's going to dilute me, to half of what I originally had in the company. What can we do? What can we contribute in order to bring my ownership back up? Sometimes that's not always possible. Sometimes it is. But you also have to look at what the value is. So again, with these private companies that haven't gone through all the steps of becoming publicly traded and giving you ways of finding an actual value of your shares or your equity ownership, the problem comes of, what is that value? So, today you might have, 10% of a company that's in its early startup phases, doesn't have any revenue generation. So really your ownership is kind of worth nothing. But if an investor comes in and let's say they put in a whole bunch of money and it dilutes you from 10% down to 1%, that's a big dilution. But, because of the money that they brought in, the company is now worth $100 million. So your shares that, at 10% ownership in the company were worth basically nothing. Now your 1% ownership is now worth $1 million. So, it's this difficult translation in your mind that you have to go through of, okay, so I have less of something on paper, as far as an ownership amount, but its value is increased. So these are the things that you have to look for, and it's always good to find someone who's been through these things to kind of walk you through these concepts and ideas, kind of like we're doing now, because there's no one right or wrong answer, which is why I can't be like, hey, this is the amount of percentage you should ask for, and this is what you should expect it to do over a certain course of time, because every situation is unique. I've had over a dozen of these different equity opportunities, and not a single one of them has been remotely similar. Each one of them is its own individual negotiation, and the way they actually play out, once money starts changing hands, once investments come in, once investments leave, once companies go public, once they do uplistings, it's another common thing that gets done. All of this stuff changes, and that's why it's important just to always be evaluating and reevaluating to make sure you, as the owner of a service providing company, know what risks you're taking on and what potential rewards you have. Because if you're that type that likes to take on this additional risk, then hey, sometimes it can really pay off. But there are plenty of times when you can be left holding an empty sack at the end.
I see. But let's say my case, when I have zero experience, what would be the most important things to pay attention to not get in trouble? Because, like, for example, it can be that my share can't be reduced or the new shares can be issued without negotiating with me. Because you mentioned that you can talk to the company owner, like what we're going to do now, but they can do it without talking to you, right? And just say, okay, we issued 1,000 more shares, so now you own just like 1%. And also, if I want to have like 10% of the company, like even if it goes in value like 100 million, I want to own 10% and get 10% of this value. So is there any ways to secure this point?
Yes, there are. It reminds me of one of my very first deals that I negotiated, because that was my approach as well. I was like, well, hey, what's going to happen? You guys are going to dilute this and everything else. And in that deal, I managed to negotiate a non-dilution clause. So, which lasted for a good while, and then eventually it came to the point where it didn't make sense to continue, because sometimes those clauses can inhibit a company's ability to grow, because if every time they bring in new investment, they need to, up the number of shares that you have, well, eventually you become the largest shareholder in the company. Even though you only started off with, let's say, a 5% ownership. But if you was 5% non-dilutable, well, while everyone else is coming down, you're moving up as far as your, total number of shares. And, before you know it, you own more than the CEO, and that's usually not looked on very well. But yes, you in theory can negotiate non-dilution clauses. Also it helps to understand how the company is structured. Sometimes what a company will do is they'll issue all of the shares they have. Let's say they have 100 shares. I'm doing this for simple numbers, but let's say they have 100 shares. They issue out all 100 shares to all the people who work there, and all of their equity has been used up. Well, now every time they bring money in, they're going to have to dilute everyone. The other option is, let's say the company has 1,000 shares available, and they only issue 100 shares out to everyone. So if you got, I pick numbers that don't really do this math easy here, but if you picked, or let's say you got 10 shares out of that initial 100, you have 10% ownership of that 100 shares, but we already know that the company can issue up to 1,000 shares. So you really only own 0.1%. At that point. And that 0.1% will probably stay constant, because as they need to issue shares out to investors that come in, those original 100 shares don't change. So you start off with a smaller piece of the pie in the beginning, but it stays consistent the whole way through.
Oh, that's good points. Let's talk about the exit strategy or cash outs. So let's say I own 10% of the company that now valued at $10 million. How can I sell my shares to get my million in my cash? Or like, how is it happening? Do I need to wait for the IPO, for the sale of the whole 100% of the company?
Mm-hmm. Okay. Well, let's talk about this. Let's say that your ownership was granted to you. Which means that you actually own it versus the options that we spoke about before. So if it's actually been granted to you and you already own it and you've got that 10% ownership, so there are a few ways that you can cash out. The first one is the easiest way. Another individual or another company comes in and buys that company for the $10 million that it's valued at. And in the course of doing that transaction, you would get paid your ownership of the company. So that 10% that you have, you get your $1 million. That's the easiest way. The next way is probably the more common way, or the next most common way, is that company goes through a public offering or a public listing. And when they do that, during the course of that, they change their shares from being privately held to publicly held, which means in theory, and I'm going to get to this in a minute, in theory, you can now sell your ownership on the open market. So in the United States, we have NASDAQ and we have the New York Stock Exchange, and we actually have a few different exchanges going all the way down to what are called the penny stocks, but they can all be publicly traded. Usually that's what's called OTC markets. So, but at that point, you could, in theory, sell your shares on the open market. What you have to be careful of is, are those shares registered, meaning that they're ready to be sold? And are you legally allowed to sell them? Meaning, are you an employee who has, privileged information and could sell your shares in a way that's manipulative, or where you have certain advantages against other people because what's coming in. It's like, the CEO is going to say that our product doesn't work at all and the stock's going to crash. I better sell off my stock now, and then in 3 months when the CEO makes the announcement, you're like, hey, I got out with my $1 million just fine. Well, that's what's often considered insider trading and gets you into a lot of trouble. So that is another option. You just have to be aware of how you can actually do it. Sometimes you have to sell your shares through a proxy where you take all of your shares, you move them over to a brokerage account, and then that brokerage firm will usually sell your shares for you at a rate that doesn't collapse the market, and in a way where you can't say when they're selling them and they don't know insider information. So, and there's a few other ways that you can do that, but that's the second option is through the public method. And then the third option is actually selling your ownership to another individual. So let's say the company is stayed private, and there's no seller who's coming, there's no buyer who's coming in to buy the company for the $10 million that it's currently valued at. But you found someone else, a friend or colleague or some random guy off the street who is like, hey, you have ownership in this company. I'd like to buy your ownership from you. So that's an option. Depending on how your contract's written, depending on how your shares are held, you might have to go through certain approvals from the company. You might have to go through some registrations, but it is another option. It's probably the least common option that I've come across. I don't think I've ever taken part in one of those transactions, but it is out there.
And what about the options that you mentioned? We talk word option a lot today, but there are options that allows you to purchase the ownership at a certain conditions, right?
Right. So usually what happens is you're given the option to purchase shares at a certain price. So let's say this is more common with companies that are either public or going to be public companies, because then there's a set value. But let's say it's for a company that's already public because it's a little bit easier. Concepts are the same, it's just the timing changes when it's private. So you own options in a public company, or you're granted options in a public company, let's say that. And at the time, the company is currently selling shares on the open market for $1 a share. A lot of times when you're granted options at that time, there's a fair market value clause in there unless you're doing other contributions. So let's say you're given your options at, you're granted options for, 10,000 shares at $1 a share. Well, today it doesn't really make sense because with the company currently being valued at $1 a share, if you were to exercise your options, you would have to buy all those shares. 10,000? So you'd have to buy all 10,000 shares. You'd have to put out $10,000 of your own money to actually get ownership of those shares. And then you could sell them on the open market for $1 a share, which means you would net out nothing except a bunch of headache and probably a little bit of cost lost to lawyers and filings and things like that. But where that does become an advantage is, let's say you've been working for the company for 5 years, and also make sure you know when your options expire. All option contracts have an expiration date, so just make sure you don't miss that. But let's assume that they're still valid. You've been working for the company for 5 years, and the company's now worth $20 a share. Well, when you're ready to exercise your options, you can go and you can buy your 10,000 shares for $10,000 because your option was originally at $1 a share. and then you can sell them on the open market for now $20 a share. Still keeping in mind what we talked about before regarding insider trading and what percentages you're allowed to sell at any given time. There's a lot of these things that you have to consider, which is why it's good to work with a good attorney and usually a good brokerage that understands how this stuff works. So they can walk you through it. But a lot of companies themselves will also have internal counsel that can help guide you through the process. But yeah, so that's your option there. Like I said, just make sure that your options haven't expired. Option contracts often expire, after 3 years, for example, or 5 years. There's usually some type of time limit put on them. And a lot of them will expire after your employment ends. So if you're an actual employee and you stop working for a company, sometimes you only have 90 days to exercise your options and sell them. Well, you don't have to sell them, but you would have to exercise them and purchase them from the company. But as an independent contractor, usually the dates on some of that stuff change. And I say independent contractor because technically as a service providing company, we are considered independent contractors or vendors for most companies, other companies that are using our services. So definitely want to make sure they don't expire. And the other thing that you run into with options is there's always, it's sad when it happens, but you're granted options, let's say at $1 a share, company does everything, raises money, operates for a few years, it finally goes public. But through all of that, things were diluted down on the private side. And so now when it goes public, its effective value is only 50 cents a share, let's say. Well, you're not going to spend $1 a share to then sell them for 50 cents a share. So you've got to just sit there and kind of hold on to them until you can figure out what to do with them. So yeah, those are the things to watch out for.
Yeah. So you mentioned that individual can sell it. So as I understand, even if my company, my business is providing the service, let's say software development, I can be owner of the shares as an individual. Is that correct?
Yeah, and it usually, there are a few different ways that can be done. What's commonly done is individuals. So I've had deals before where I've had a development team working on a project and that company was like, hey, we want to give you and we want to give your developers an equity stake. So they granted options to the developers, they granted options to me, and then we had that way to go. You can also put the options into the company. It's not as common, but it can be done that way as well, depending on how you may want to redistribute them or redistribute the sale of those shares and equity holdings within your own company. So it just kind of depends on what you actually negotiate. Most of the time, I've negotiated direct ownership of shares, but I have done times where the company owns the shares and then they sit there as an asset for the company. Again, you'll want to make sure you've got in this case, an accountant and a tax professional to tell you, what implications those have, which you should be doing on the personal side as well.
So what would be the best, but probably not the best, but most common approach when company usually share equity and it works well? Because at very early stage, idea stage, that probably can be 50% of the ownership. And at a later stage, it can be 1,000 share and doesn't make a lot of sense for the software development company to reduce the cost significantly. So from your experience, what is the common way to common stage of the company to go with this option?
I don't think there's really a common stage so much. It's really just what your risk profile allows you to do. When you do it in a later stage with a company, let's say they're offering you 1,000 shares for a discount, and you can do that. You can say, hey, these shares, let's say they're asking for over the course of a year a discount of $20,000. Not a lot, but let's just say they're asking for that. And let's say that equity that they're granting you, in this case, it would need to be a grant to make sense, is worth $10,000 today, but you think by the time the company grows and by the time you make your contributions as a service provider, that it's going to be worth $50,000, which is well more than the $20,000 discount you were asking for, or they were asking for. Then it's kind of worth it when you're still talking about actual share counts. So, because again, the risk that you run into, at the very early stages, you may be offered 50% ownership, let's say, if it's just you and the CEO starting this together, but you really don't know what that's going to be worth or when it's ever going to be worth something. So you really have to take these on a case-by-case basis. And I usually recommend, having someone that you can talk to about it. There are financial planners out there who assist with these things. And then there are other people in the industry, so to speak.
Okay, so I believe we covered a lot of questions today. Kurt, thank you so much. Guys, if you enjoyed this video, please support the channel with like and subscription, and let us know in the comments below what else you would like us to highlight.